You turn on the TV, you look at your news feed, and it is all-consuming. Headlines are screaming about global conflict, and it's sending investors scrambling. But what if Wall Street is fighting the completely wrong war? Today, we're going to dive into the evidence that suggests the biggest threat to your portfolio isn't the one plastered all over the news, but a massive, hidden risk lurking deep inside the financial system. So here's our game plan. First, we're going to tackle the threat that everyone sees, geopolitics, and I'll show you why markets are, surprisingly tough. Then we'll pull back the curtain on the real story, a potential $1.7 trillion black hole in the system. We'll weigh the odds of each threat and then wrap it all up with a concrete defensive playbook you can actually use for your portfolio. All right, so let's start with the obvious. Open any financial news site and you're just bombarded with headlines about global conflict. It's the dominant narrative, right? These events feel absolutely huge, and their effects seem immediate. But the real question is, how deeply and for how long do they actually impact your investments? Well, empirically, it really happens in two main ways. First, there's what we call the real channel. This is the physical world stuff. Supply chains getting tangled up, prices for critical things like oil and gas suddenly spiking, and that causes short-term inflation. Then you have the financial channel. This is pure market psychology. Investors get spooked, they sell risky assets, and they run for safety. And that's when we see volatility, the VIX, the market's fear gauge, just shoot through the roof. So yeah, the initial shock is very real. I'm not denying that. But is it a lasting threat to the health of your portfolio? This is where the common narrative really starts to fall apart. When you look past those scary headlines and actually analyze the historical data, a very different picture starts to emerge. So let's just ask the question directly and let the numbers do the talking. How do markets really react to war? Not in the first 5 minutes, but over the medium to long term. The data shows this clear pattern of resilience. It's fascinating. After 9/11, the S&P 500 took a massive 12% hit, but it recovered everything in just 30 trading days. Or look at the Gulf War. The market dropped 17% before the fighting even started in anticipation. The moment the conflict began and that uncertainty was gone, a strong rally kicked off. We even saw a similar pattern in 2022. The initial shock from the Russia-Ukraine war was sharp, no doubt, but the market's focus snapped right back to the things that really matter, inflation and what the Fed was doing. And this really reveals the key takeaway here. The market's true enemy isn't the war itself. It's the uncertainty leading up to it. Once a conflict becomes a known quantity, a risk that can be modeled, it gets priced in. And then the fundamentals, earnings, interest rates, they take back the driver's seat. Okay, so if geopolitical conflict isn't the systemic portfolio-ending threat it's often made out to be, what is? Well, the real risk, the one that Wall Street isn't pricing in, is hiding in plain sight. It's a massive, totally opaque, and rapidly growing corner of the financial world. Welcome to the world of private credit, often called shadow banking. This is where private funds lend money directly to companies, completely bypassing the traditional banking system. And in the last 15 years, this market hasn't just grown, it has absolutely exploded. We're talking nearly 10 times bigger. To put a number on it, just to let it sink in, the total assets under management in the global private credit market today stand at an estimated $1.7 trillion. That's trillion with a T. And here's the thing, this problem is accelerating. Projections show this market could more than double to $3.5 trillion by 2028. And this isn't some far-off threat somewhere else in the world. About 60% of this ballooning risk is concentrated right here in the United States. So why is this a systemic risk? It really boils down to 4 huge problems. First, it's opaque. It's a financial black hole with no public price discovery. We have no clear idea how these loans are actually valued or how many companies are secretly failing. Second, the floating rate trap. Most of this debt has variable interest rates. So when the Fed hiked rates, these companies' debt payments skyrocketed literally overnight. Third, we've got Covenant-Lite loans. In the frantic search for yield, lending standards just got thrown out the window, meaning fewer protections for the lenders. And fourth, and this is the real kicker, interconnectedness. This isn't some contained system. Your regulated bank, major insurance companies, maybe even your pension fund, they have massive exposure. A wave of defaults here won't stay in the shadows. It will spill directly into the core financial system. So how do we weigh these two very different risks against each other? Let's try to approach this like a statistician would. Instead of making these absolute this will happen predictions, let's just compare the probabilities of each of these threats actually causing a sustained market crash. And when we apply this kind of framework, the verdict becomes pretty clear. The probability of a sustained crash from a geopolitical event is, based on history, low. Markets recover. But in contrast, the probability of a crisis coming from this private credit space, that's medium to high. In the current high interest rate environment, a big jump in defaults isn't just a possibility, it's a mathematical inevitability.
And we already have proof of this in the public markets. I mean, look at this. According to Moody's, the default risk for publicly traded high-yield bonds, junk bonds, has already shot past 9.2%. That is a level we have not seen since the Great Financial Crisis.
So that leads to the really scary question, right? If the default risk in the transparent, more regulated public market is already at post-crisis highs, what on earth is the true hidden default rate in the far riskier and completely opaque private market? The evidence suggests it's almost certainly much, much higher, but it's being hidden through complex debt deals and all sorts of other financial engineering. So this all brings us to the most important part. What do you do about it? When you're faced with a risk you can't see and you can't measure, you need a clear defensive strategy. So here is a simple 3-step defensive playbook. Step 1, raise cash. Building liquidity now, having that dry powder gives you the firepower to buy quality assets at a deep discount after a correction. Step 2, accumulate gold. It's the classic hedge against geopolitical risk, sure, but more importantly, it's a safe haven against a loss of trust in the financial system itself. And step 3, rotate to quality. It's time to move out of these highly leveraged companies and into businesses with rock-solid balance sheets, focusing on those defensive sectors like healthcare and utilities. The result is a portfolio that's structured not just for growth, but for resilience. This means having a strong allocation to cash and cash equivalents, a meaningful position in gold, and a core portfolio built on high-quality defensive stocks. It really all comes down to this simple idea. If you can't see the risk, you can't price the risk. And if you can't price it, you probably shouldn't own it. The headlines will keep you focused on the wars you can see on a map, but the real danger might just be hiding on the balance sheets you can't. And the final question is pretty simple. Why would you take a risk that you can't even measure?